faith arising. I'm crawling out the trenches, holding me.
Hello visionaries, welcome back to my channel. My name is Maresa Talbert. I'm the founder and CEO of Talbert Law Office, your favorite go-to legal resource for all things business, nonprofit, and intellectual property law. Okay, so we're picking up right where we left off with C corporations. And today we're going to talk about the C corporation's little sister, the S-Corp. Now, just like the C-Corp, the S-Corp also gets its name because it is governed by Subchapter S of the Internal Revenue Code. If you are looking to form an S-Corporation, you would follow the exact same requirements as the C-Corporation, with one difference. You must submit Form 2553, election by a small business corporation, to the IRS that is signed by all of the shareholders. While the formation of an S-Corp is almost identical to the C Corporation, there are some vast differences between the two and how they operate. But first, let's talk about the similarities between the C Corp and an S-Corp. Number one, an S-Corp is merely a tax designation, but it still gives you that separate legal entity or the separate legal person, just like the C-Corp. Number two, the S-Corp offers the same limited liability protection of a C-Corp. Number three, the S-Corp does require the same formalities and governing documents as a C-Corp. If you need to review these formalities, I will place a link of my last video that talks about the C-Corp up above and in the description box below, which breaks down all the details. And number four, the S-Corp maintains that same corporate structure between shareholders, directors, and officers in the same manner as the C-Corp. I'm not going to go through and explain all of these similarities in great detail. I really just wanted to point them out because this video is really to focus on the differences between the S-Corp and the C-Corp. If you want to know more about what I just talked about, you can check it all out in the C-Corp video, linked up above and down below. Okay, so let's jump into these differences, starting with corporate ownership. So we learned that a C-Corp has no restrictions on who can own shares and how many they can own. However, the S-Corp has a restriction and a maximum of 100 shareholders. So an S-Corp can never be publicly traded, and it's limited in its ability to raise capital and bring on new investors. Additionally, shareholders can't be anybody like the C-Corp. They must meet an eligibility criteria. In the S-Corp, a shareholder may be an individual, certain type of trust, or an estate. Individuals must be U.S. citizens or U.S. residents. And in the S-Corp, a shareholder cannot be a partnership, it cannot be an LLC, and it cannot be another corporation. Additionally, unlike the C-Corp, the S-Corp cannot have multiple classes of stock. It is limited to one class of stock only. Again, this may hurt the ability to bring in investors who really enjoy those special privileges that come with having different classes of stock, such as being the first to get dividends. Furthermore, because of this eligibility restriction, S-Corps really have to limit how their shareholders sell or transfer shares in the corporation. This is to make sure that an S-Corp does not end up taking on an ineligible shareholder and then losing their tax status with the IRS. It also makes it harder for shareholders to exit and leave the corporation. And the last major difference that I want to cover is the tax status. One advantage of an S corporation over a C corporation is the tax status, and it's the reason why most people elect to be taxed as an S corporation. An S corporation does not incur double taxation like the C corp. S corps instead experience pass-through taxation. That means that the corporation's profits are not taxed. Only dividends to the shareholders are taxed at their individual income levels. An S-Corp also allows shareholders to claim what's called the Qualified Income Business Deduction, or QBI. QBI allows corporate shareholders to deduct up to 20% of qualified business income from a domestic business operated as a sole proprietorship, partnership, S corporation, trust, or an estate. Lastly, an S corporation may help to reduce self-employment taxes. As we've learned through this series, pass-through entities incur self-employment taxes at a rate of 15.3%. This occurs when a self-employed individual has to pay both the employer and the employee's Medicare and Social Security tax. However, in an S corporation, if you pay yourself a salary, then the S corp pays the employer part of the self-employment taxes, and you, as the employee, pay the employee half of the self-employment taxes. And then the S corp can write that salary off as a business expense. Now, in order for you to actually take advantage of reducing your self-employment taxes, the IRS requires that you pay yourself a reasonable salary. However, of course, reasonable is not defined. So the rule of thumb is to do a 50-50 split between the earnings of the corporation and the salary. All right, I think that's all I got for this video. Short, sweet, and to the point. Let me know in the comments if you have any questions. If this was helpful, please give it a thumbs up. And as always, this is Talbert Law Office, your favorite go-to legal resource for all things business, nonprofit, and intellectual property law. I'll see you in the next video.